Imagine waking up tomorrow and seeing a headline everywhere. A major bank has just collapsed. Customers are rushing to withdraw their money. Financial markets are reacting, and suddenly one uncomfortable question appears. What happens to the money inside the bank? More specifically, when a bank fails, who gets paid first? Most people assume the answer is obvious. They believe depositors should be first in line, because after all, it's their money. But the reality of the financial system is very different. When banks collapse, there is a strict order that determines who gets paid first. And surprisingly, you are not at the top of that list. Understanding that order reveals something most people never think about: how the financial system actually works when things go wrong. The illusion of safety for most people: banks feel safe. Your salary arrives in your bank account. Your savings are stored there. Your financial life is built around that account. Because of this, it's easy to assume that the money inside the bank simply belongs to you and can always be withdrawn whenever you want. But banks do not actually operate like vaults storing everyone's money. In reality, banks operate using a system built on lending, leverage, and trust. When you deposit money into a bank, the bank does not simply keep it there waiting for you to come back. Instead, most of that money is used to issue loans, buy assets, and finance economic activity. This system works smoothly as long as people trust the bank and withdrawals remain predictable. But when trust disappears, the system can become unstable very quickly. And that is when bank failures begin to happen. What actually happens when a bank fails? A bank collapse usually starts with a loss of confidence. Investors begin to worry about the bank's financial health. Customers start withdrawing their deposits. Financial markets react. If enough people try to withdraw their money at the same time, the bank may no longer have enough liquid funds to meet those demands. This is known as a bank run. That moment, regulators may step in to stabilize the situation. But if the bank cannot recover, it enters a formal resolution process. This is where the real mechanics of the financial system begin to appear. Because when a bank fails, its remaining assets must be distributed to the people and institutions that have claims against it. And those claims are paid in a very specific order. The payment hierarchy: when a financial institution collapses, there is a legal structure that determines who gets paid first. This structure is called the creditor hierarchy. At the top of the hierarchy are secured creditors. These are lenders whose loans are backed by specific collateral. Because their loans are protected by assets, they are usually the first to recover their money. After secured creditors come unsecured creditors. These include institutions and investors that lent money to the bank without specific collateral. Then come bondholders. Bondholders are investors who purchase debt issued by the bank. They are part of the financial structure that funds the bank's operations. Only after these claims are addressed do depositors begin to appear in the repayment structure. And even then, the situation can become complicated. Where depositors really stand, many people assume that depositors are always first in line. But in reality, depositors are part of a much larger financial structure. In many modern banking systems, depositors are protected through deposit insurance programs. For example, in the United States, the Federal Deposit Insurance Corporation protects deposits up to a certain limit. This protection helps maintain confidence in the banking system. However, deposit insurance has limits. Large deposits above those limits may not always be fully protected. And during systemic financial crises, even insured systems can experience significant stress. In those situations, the distribution of remaining assets becomes far more complex. Why banks are built this way? This structure may seem unfair at first. Why should large financial institutions or bondholders be paid before ordinary depositors? The answer lies in how banks raise money and operate within financial markets. Banks rely on multiple sources of funding. Deposits are only one part of the system. Banks also issue bonds, borrow from other institutions, and interact with large financial markets. Because of this, the financial system creates a hierarchy of claims designed to stabilize lending and investment. Investors who provide secured capital receive priority because their funding helps maintain financial stability. But this structure also reveals something important. The financial system is designed primarily around institutional stability, not individual depositors. The real risk most people never think about. For most of the time, none of this matters. Banks operate normally. Deposits move smoothly. Customers rarely question how the system works behind the scenes. But during financial crises, the hidden mechanics of the system become visible. Suddenly, people begin asking questions they never considered before. Is my money safe? Who gets paid first? What happens if the bank fails? And the answers often reveal that the financial system operates very differently from what most people assume. How financial crises spread bank failures rarely happen in isolation. They often appear during broader financial stress. Rising interest rates, economic recessions, or asset bubbles can weaken financial institutions. When confidence begins to break, the entire system can become unstable. Banks depend heavily on trust and liquidity. If either disappears, even large institutions can collapse surprisingly fast. History has shown this many times, from the global financial crisis to regional banking failures. The same pattern appears again and again. When confidence disappears, the financial system quickly reveals its hidden structure. Why understanding this matters most? People interact with banks every day without thinking about how the system actually works. They deposit money. They pay bills. They assume the system will always function normally. And most of the time, it does. But understanding the structure behind the banking system can completely change how people think about money, risk, and financial stability. It helps explain why governments regulate banks so heavily, why central banks intervene during crises, and why financial stability is such a fragile balance. After a bank officially collapses, regulators and financial authorities step in to manage the situation. Their first objective is usually to prevent panic from spreading through the financial system, because when one bank fails, people often begin to question the stability of other banks as well. To avoid a chain reaction, regulators may freeze withdrawals temporarily, restructure the bank, or transfer its assets to another financial institution. Sometimes another bank may acquire the failing institution and assume its deposits and operations. In other cases, the bank may be liquidated, meaning its assets are gradually sold in order to repay creditors according to the established hierarchy. This process can take months or even years, depending on the complexity of the bank's financial structure. And during that time, different creditors receive payments based on their priority level. This is why understanding the structure of the financial system is so important, because when a bank collapse happens, the system does not operate based on assumptions or expectations. It operates based on legal priority and financial hierarchy, and that hierarchy determines exactly who recovers their money first. Conclusion: when banks fail, the financial system does not simply distribute money back to depositors first. Instead, it follows a structured hierarchy designed to protect financial stability and institutional funding. Secured creditors, investors, and other financial participants often stand ahead in a repayment order. Depositors may be protected through insurance programs, but they are still part of a much larger financial system. Understanding this reality does not mean banks are unsafe, but it does reveal something important. The financial system operates according to rules that many people never see. And once you understand those rules, you begin to see the banking system in a completely different way.